All right, it's Thursday morning, 10 o'clock. Welcome to another podcast. Tom and Shane, No Business and Politics. And I'm Tom, and Shane's in the middle. And our special guest, Mike McCormick, money guru of Bozeman, Montana. What a guy.
Whoa.
He's cooler than the other side of the pillow. And we're happy to have you, Mike. Thanks for being here with us.
And looks better than a fresh cucumber.
Doesn't he, though? I'll be
I,
darned.
I appreciate you both a lot. Thank you. We all love the love. I love the love. Love to be here.
Well, Mike, all we want you to talk about today is how to turn $1 into $2. That's what we need to know, Mike. We need to know how to double our money.
What do you want to do for the remaining 59 minutes of the show then, Tom?
Yeah, right. Well, one of the questions that I had for you, Mike, to kind of start off in, is there a bad time to invest? Looking at the stock market, it's gone steadily up since 1929. So is there, I always say there's never a bad time to start a business, ever. So what do you think?
My phone agrees with you.
That was a nice cheerful ring,
Yeah.
Shane. Well, again, thanks for having me, Tom. And I gotta interject a bit with the standard disclaimer. I'm a registered investment advisor with my firm, McCormick Financial Advisors, in Bozeman, Montana. We help wealthy individuals stay wealthy. Fundamentally, that's sort of the reality of it. We do soup to nuts wealth management, and it's a great job. It's a great place to be. And what it means is that for you tuning in, if you're not one of my clients, things that I say I can't be held liable for. This is information that I put out there for you, that we provide to you as accurately as possible. So careful with it. That's the gist of that. Now, Tom, to your question, when's the right time to invest? Is it always a good time to invest? I like that saying of when's the best time to plant a tree? Yesterday. And so that is fundamentally true with investing, whether you're into real estate or you're into collectibles, you're into stocks. Of course, we all wish we would have bought Facebook back when Tom bought Facebook. We all wish we would have started a Roth IRA back when Tom started a Roth IRA. And so the same metric of, the sooner you do it, the sooner you can benefit from it is true. Which way is the stock market going to go? Well, in the past 10 years, 12, really, the stock market has gone straight up. So certainly the best thing that I could have done for the past 12 years was to go to all my clients and say, give me all your money. I'm going to invest it today. Don't wait. Don't wonder about what your tax bill is going to be. Don't wonder about how your income is going to be this year. Give me all your money and I will invest it today. And we would have all been better off. But of course, that's not how it goes. How it goes is that each person has their own individual situation, and each business has its own individual situation. And so when is the right time to invest? The right time to invest is when you have a solid financial foundation and you have a reasonable expectation that that foundation is going to stay the same or improve going forward. Because even though it seems like you can't lose in the stock market, we know that's not true. And we know Murphy's Law is right around the corner. And when you least expect it, you expect it. And that is really when we are going to see this big market pullback that everybody's been talking about for 3 years now. Even before the pandemic, we were talking about it. The simple answer is when we all become complacent that you can't lose money in the stock market, that might be the most dangerous time. And we may be getting there right now. So I think that this is one of those times where you need to really get some good discipline into saying, if you are starting out investing right now, think about what just happened. You just walked into a party. Everybody is drunk on money in this party. You just showed up. And so much like Animal House, when the young gal shows up and says, I've got some catch up to do. How did that end up for that young gal, right? Yeah. That is where we need to be careful.
Yep. Well, that's what I'm thinking. When people think about investing, a lot of times they'll think about, I've got to pick a single stock. And of course, there's exchange traded funds. There are things like the spider groups and, all these other investment things, Mike. It's better to put your a few eggs in a lot of baskets rather than all your eggs in one basket?
We have two ways to mitigate risk. People say, lots of times people, hey, Mike, all I want to do is make money in the stock market without any risk. Do that for me, right? And so I say, well, of course, if I had the answer to that, I'd be on a boat in Barbados right now, and you guys would be along. Just for the record, you guys would be there. But when we're talking with somebody from the big picture, there's two tools that we have to mitigate the risk. We have time, because there's been no 10-year period that there's been a losing dollar in the stock market. If you would have done nothing in any 10-year period and put it into the S&P 500, assuming that you didn't pay unreasonable fees and etc., you would end up after 10 years with more money. So you could take the highest day before the Great Recession, the highest day before any of the big pullbacks that you want, and you fast forward 10 years and you would have more money. So time is the way to do that. And that means that you might have to put the blinders on for 10 years. It might be terrible, and most people can't endure that ride. So most people, have different outcomes. However, that one says, okay, if you can commit money that is in there for 10 years, yeah, you've kind of got a no-lose sort of thing going on. Asterisk, asterisk. Now, the other one is we do diversification, which is the not all your eggs in one basket. And that means that you can go to the horse races and you can bet money on every single horse, because one of those horses is going to win. And unlike horse racing, the other horses don't necessarily lose either. So you have the opportunity to spread it out. Now, the thing about diversification, Tom, is everybody wants diversification until they get it. Because what that means is that you could go in and see your advisor right now and say, how come I'm not up as much as the S&P 500? How come I haven't made as much as my friend who owns Tesla? Well, the answer is that we don't put it all in Tesla, because we don't know that Tesla is what it's going to do in the future. So we spread our bets out. And so diversification means that you're going to own things that are underperforming, and you have to acknowledge that that's okay. Now, most investors don't go under the hood enough to see that. You might own a mutual fund, or as you say, an exchange traded fund. And those say, well, you have this gift basket of things, and inside there might be winners and losers and mediocres. But as an average return, we've blended that, and we show you your average return. If they opened up the hood, they might see, oh, we own some real stinkers in here. Why are we owning that? I just want to own the ones that win. No, diversification means that you plug your nose and you're in the hole. You're like a Rice Krispie in a cereal bowl. You're just floating along.
Yeah. Yeah. Shane, you've advised people for many years on stocks and things like that. Same question to you, I guess. What triggers do you look for? What magic red flags or green flags do you look at?
Well, Shane's investment advice, 1.1 is basically three things. Number one, I always remember that buying a stock, because that's what we're talking about specifically, does not make it only provides an increase in value, increase in equity. You only make money when you sell it. And if you sell it at a loss, then you don't make any money. So fine, it's not money in your pocket until you sell it. Number two, I always pay attention to the capitalization of any stock you buy, meaning how many shares are issued and outstanding on that stock, small or large, whether it's Dow 30 or, the S&P 500. I always check. It's very relative to two things: earnings per share, which is one way of looking at it, absolutely, especially if it's highly capitalized, like Microsoft with 7.9 billion shares out on it. And then, of course, number three, I always have decided what you would accept as a percentage gain, not to reduce your ownership, but to reduce your risk and go into cash. You can't be in the market and not have cash to buy. So you always have to be in a position to have decided already if you've reached a peak where you start seeing enough profit, and you don't have to sell it all, but you can add to the cash in your account. Being in cash is king. That's the single most important aspect of the market, and that's why people have made so much money, in the last 10 years, because people that have sold when the market's been moving up have gone back in and rebought when it has happened to correct a small amount. But even in this market with the prices of stocks right now, because there's so limited number, stocks are trading at such high, triple digits that, $200, $300, $400, $500, $600 a share. So, a 10% drop is quite significant. It wasn't before when they were double digits. So there you go. Shane's tips for smart investing 1.1. Finally, the only long-term stock I'd ever buy is a dividend-paying stock. Unless the company's prepared to pay me to own their stock, I'm not going to own it long-term. I'm just going to trade it.
Yeah. Yeah, that's well, another thing to think about too is this when you're talking about.
Okay, no, I'll go on with my second point that I wanted to make today. I've got a stock that I think. You're freezing up. That's what's happening. Yeah.
Okay.
Okay, so the other thing I want to make reference today is one thing that I've sort of been looking in anticipation of Mike being back. A stock called Nvidia. Nvidia is it's trading around $390. I expect that. I have to look at the chart here. It's 320. It's up about 140%. It's up $28 today, up almost 10%. I expect this to go over $1 trillion before the end of the year. It's a NASDAQ stock, NVDA. Remarkable company. He's just had such superb success with this company in increasing its earnings per share, and with 2.5 billion, 2.5 billion shares out at at 320, you're heading towards $1 trillion very quickly. It's over, obviously close to 900 billion already. So there's a reference of something to look at. And finally, because we're just here in the moment, I want everybody to know that the reason that you saw a drop in the price of oil yesterday is led once again by the Biden administration. The Interior Department announced yesterday that it's auctioned off more than 300 drilling blocks in the Gulf of Mexico, 1.7 million acres. They generated almost 200 million in revenue from the bids. Chevron's top bid was 47 million for several blocks, followed by Anadarko, BP, and Royal Dutch. And the other reason is that the market was surprised that the oil supply was expected to be smaller in the U.S. And so in oil production in October was 1.4 barrels per day, and will and so they expect it to be less, and it will further add another 1.5 billion barrels a day in November. So finally, the most important thing to look at is booming. There's 282 rigs that are operating now in the United States, up from less than 100 in August of 2020. So always look at the numbers. Don't listen to the politicians.
Okay. All right. Thanks, Shane. All right. Sounds good to me. I don't know. Well, the other thing to look at, guys, when we talk about $300 stocks or so, and we're talking about small investors, that maybe have 10 grand to invest. So they're going to end up with about 30 shares of stock. And if, as opposed to, say, buying a $50 stock. So if the $50 stock goes up $5 and they've got 200 shares, they made $2 grand. I mean, pretty nice. If my Facebook goes up $5, I make a few $100s.
Well, that's why I always like to think of things in percentages.
Yeah.
Because then that's applicable to, whether you have $100 portfolio or $100 million portfolio. The numbers are all the same. I really wanted to punch home something Shane said about dividend stocks, and Tom and I have visited about dividend stocks also. What that means is that the company, as they make money, they distribute some of those earnings to the shareholders, and that makes perfect sense. That's what most company owners get when they make money. They, in addition to the salaries that they pay, they might distribute bonuses, and they certainly distribute a bonus to themselves. And so when you own a share of a publicly traded company that pays dividends, you're really just getting money off the table. And to Shane's point, what that does is that reduces your risk over time. So if you bought a $300 stock and it pays you a $5 dividend, you now have $295 at risk without having to have done any trading about it. You have less risk over time. And you also have the ability to have liquidity. That $5 in dividend, you get to choose. Do you want to use that to live on? Do you want to reinvest that? Maybe you want to diversify. You have all these flexible options based upon the ability to make real-time decisions. Now, does that mean that you should only own dividend-paying stocks and steer away from other stocks? Well, again, in hindsight, the growth stocks have been crushing it. Growth has been great, and the market has been wanting growth. The momentum factor investing has been all about going with the trends. And many of these companies are not paying dividends, and they're deciding to take that money and reinvest it back into the market for growth. NVIDIA is probably one of them. I'll look and see what their dividend is right now. And Shane's absolutely right that NVIDIA is on a tear. They have done extremely well. They're in the gaming space making chips, and they're also making chips. Well, they're making chips for the automotive sector, which has had a really tough go of it. NVIDIA pays a 16-cent dividend on their price of a stock, which is about $300. So that's effectively, not really paying a dividend. But, it shows that they have free cash available that they're able to reward their investors with. You can find the dividend on each stock by using, I use Yahoo Finance, even though I'm a sophisticated, experienced financial advisor. It loads quickly. And I like to use the information that's other people are looking at. I can go through Schwab. I can go through other trading platforms and find out more detailed information. But use something that you're comfortable with and get used to looking at these metrics. Like Shane said, the price to earnings ratio is an important one. That's a relative valuation on how expensive it might be. Look at the dividend. Look at the history of the dividends, because companies are allowed to suspend them in tough times, as many did during the pandemic, and then reinstate them, or they can even raise them if things are going well.
Yeah. Well, the other thing about dividends too is they're paid whether the stock goes up or down, is a good thing. That certainly pays off. God, there's another thing I wanted to ask you, Mike. It went right out of my brain.
That's okay. We've got plenty of time. No hurry.
I know. Looking at the market in general, it went up over 36 and then it tanked again today, and then it'll probably by the end of the week. I think part of it is people are concerned about this vote in the Senate on the big spending bill as to what they're going to do. I think people are getting into cash to see if they need to move something someplace or other. So that may be an issue. That's one of the things that I'm doing is moving some stuff into cash. So just to be a little safe.
Shane, tell us what we should be doing right now.
Look, we've been talking about this for 6 months, and now it's sped up in the last 35 days, Tom. So Shane's auction news, Treasury auction news, from yesterday is horrific. Once again, you have this huge disappointment with the Treasury Department and in its efforts to fund your debt. And they went out yesterday and made an effort to fund the debt, or your country's debt, and roll it over. 162 billion was offered to the primary dealers out there. 41 billion was accepted.
Okay.
So
is that a Mike?
We've gone from seeing a 50 to 70% purchase of debt, weekly debt in the Treasury offering in the last 4 months. 6 months ago it was about 80% now, and it dropped to 60-70% 4 months ago. Now it's down to like 20 to 30%. So it's not about the debt, interest being paid on the debt. It's being able to even have someone buy any more debt. It's a very scary situation, one we have to keep watching, and that's the biggest concern I have.
Mike, is there an offset to what Shane's talking about?
Well, the debt and interest rates and federal funds rate and auctions and global currencies are obviously very complicated. Shane's got a good grip on that. My view is from the individual investor standpoint. It's what is the impact on individual investors. And for a long time now, we've had money being scared out of bonds and into stocks. And that's because there's no return on bonds. The yield for loaning your money out is never been lower in my experience. And the idea that I could get somebody a safe return on a 10-year treasury that would pay, what are we at right now? 1.57%. Yeah. Meaning you loan your money to the federal government for 10 years, and in return, you get an annual yield of 1.57%. Yeah, that's not worth it, right? It's not worth the lack of liquidity.
No. Wow.
And so, where does that leave the individual investor? It means, well, you might have once said,
everybody looks frozen. Anybody alive, or is it just me? I'll talk.
It's just you. It's just you.
About the boys
Mike's doing fine.
Is
we got that private chat feature, Tom? Maybe that'll work.
Yeah, there you go.
We are seeing heavy distribution of market selling across the entire market, even though we just watched 30 stocks on the Dow Jones.
Oh, look at that.
Yeah.
You did that, didn't you?
Yeah.
It's good to be in control, isn't it, Tom? Sometimes. We've got a fascinating situation playing out where the U.S. government's been going into debt for quite a while now, and we have no indication that we're going to slow down with this new infrastructure bill. And so going there, we're looking to borrow more money. That does mean that we're auctioning off our debt. That does mean that we put ourselves out there just like a Calcutta. Who wants to buy us, right, is what it is. And Shane's great at following that and seeing how that the demand for that has shown some weakness, which of course is logical. At some point when Uncle Larry comes to you and needs another loan, at some point you're saying, I don't know if I want to loan. We already kind of have a lot of money out with you right now. And I'm not sure how much more credit I'm going to give you. And that's exactly the same thing, because we have no fixed credit line of the U.S. government. There's no set number like you have with your Chase Rewards card on how much you can draw. It's just sort of, okay, we'll see what happens. And what we're seeing is that there still is a ton of liquidity out there that needs to go somewhere. And we see this in the town of Bozeman. We see this, I'm in California right now. We see this everywhere we go, where there is extra money. Everybody has extra money. And so even though it's not the best answer, we've got a situation where everything gets bid up, and that includes money and bonds.
All right. Thank you, Mikey. What are you doing in California?
Thanksgiving week is a big reunion time for me and my family.
I'm frozen, you're telling me?
I'm back early. because why not?
Yeah. All right. Sounds good. All right. I don't know about people out there. Mike and I can hear each other perfectly. We are having a problem with you, Shane, but I guess, can you hear me, Mike? Okay, I'm not freezing up, or
you've been coming in 10 by 10 the whole time, Tom.
Okay, so well, we always have issues with this, and now I can't hear Shane, so I don't know. maybe it's time to end it.
It's your show, Tom. You tell me how you want it to go.
All right. Well, I think we've covered what we wanted to cover today. Shane got his stock in, and the Treasury report, and Mike gave us some good insight on what to look for anyway. And that's the important thing. We got to know what to look for.
We do, and I think that it's really, we're in this environment where we have excess liquidity, meaning everybody wants to be a spender right now. Very few people want to be the workers. We've got a Christmas rally that's in progress, and thanks to the supply shortages, myself and others have been buying things early for Christmas. And so, I thought at one point 2 months ago, maybe we'd have a pullback so that we could have a Christmas rally. That pullback really didn't appear. And so we are boosting things all the way through Christmas. I think we're going to have great consumer spending numbers all the way through. I think that the hangover after Christmas could be significant. That could be a time to be cautious. And until then, here's the simple playbook that I've been giving people is, let's say that your risk profile might be medium, right? Let's just say you're a medium risk profile investor. Well, in the past, what that meant is that we would blend together stocks and bonds and cash and get you a medium heat sort of experience. Well, now, like I said, because these bonds have been yielding hardly anything for taking the risk.
Oh, really? I'm fine. I can hear you, Mike. Yeah.
Great.
Yeah, you've been picking up on me, Tom, but I seem to be okay in hearing you.
All right. And so what we've been doing is we've been putting people at more risk and then also giving them a big cash buffer. So I think it's a fine time, even though inflation's real, it's a fine time to sit on some cash, allow you to feel comfortable that you might own these high flying stocks, that you might have the confidence to go and invest in NVIDIA, as Shane says. And the reason why you can do that is because you can endure what might be a really uncertain time because you've got some money safe. That's the simple lesson that I have.
All right. Sounds good. All right. Need to remind you, Shane and I will be live Saturday morning, 8 to 11. Smile, Shane. That's a good thing. We'll be on kmmsam.com. Click listen now, 8 to 11 Mountain Time. And, of course, if you want to listen to any past shows, including this one with Mike McCormick, you can do that at kmmsam.com. And, of course, we always appreciate it if you will subscribe to this channel, hit the notification bell. You'll never be, you'll always know when there's another podcast, and like us, leave a comment. Let us know what things you'd like Mike to talk about when Mike is here, or Shane and I to talk about. So we would appreciate that. Appreciate that very much. So Mike, thanks so much for being here, man.
Hey, I really appreciate it, guys. If anybody wants to get a hold of me, the Google sphere can find me. And
we'll put your info in the YouTube and Facebook deal as well. So,
all right, I appreciate that.
Yeah, absolutely. Shane, thanks, man. Okay.
We appreciate you, Shane.
All right, man. All right, we will see you. We'll see you guys next week. So take care.